Okay, good day, audience. This is the second session of SBR webinar March 2022 attempt. Uh, those who have didn't attend the last class, they can see the recordings. Okay, and yesterday we were on exemptions from consolidation. Kindly hit the chat box. Is the voice and the screen sharing and the video is perfect? Please hit the chat box. And one thing regarding chat box, you can only see your chat. I can see everything combined chat. Okay, so don't worry about it. You whatever you write, I can see, but you will write your own chat only. Okay, good. Okay, students, as you all know, there is a topic which we call exemption from consolidation. Listen to me very carefully. For example, there is a parent company and it has 4 subsidiaries: subsidiary 1, subsidiary 2, subsidiary 3, subsidiary 4. Okay, out of these 4 subsidiaries, 3 subsidiaries are excellent. They are very rich subsidiaries with high profits and excellent numbers, but one subsidiary is in loss. So normally what parent company director wish, they want to exclude such subsidiaries from consolidation, right? So in past there were certain exemptions, like for example, in past, if the line of business of parent company and subsidiary company is different, then you can exclude from consolidation. And you know why this exemption was allowed? Because there is a possibility, for example, parent company is a bank and subsidiary company is in manufacturing sector. So have you ever seen the income statement of bank? It's totally different. It's not like sales, cost of sales or such things. And the subsidiary company income statement is manufacturing. So how will you add these two? Adding together would be very difficult, very difficult. So that's why in past standard gave the exemption from such consolidation, but you know, people did misuse. Accountants did misuse, and they intentionally excluded those subsidiaries which were highly geared. They excluded those subsidiaries which were in losses. Okay, so then finally standard board has removed that exemption. Okay, but still there are certain exemptions still left. There are certain exemptions still left, still there, and that is investment entity, and it's a non-routine topic, so be very careful. I'll explain you now. If you guys want to invest in stock exchange, attention students, if you guys want to invest in stock exchange, what is the first way? You go directly open your account in a stock exchange and start investing. Start directly, buy the shares. You buy the share of Apple, you buy the share of Tesla, you buy the share of Google. But listen to me very carefully. For this you need time, for this you need research, for this you need to be very active whole day, because stock market fluctuates extreme. There are extreme fluctuations in stock market. So there is one more route, and the second route is mutual fund. What you do, see the screen. You are an investor, you go to this mutual fund, and you buy the units, you buy the equity units from this mutual fund. Okay, that means you have given money and they have given you units. Now they will invest your money in the stock market. These mutual funds will invest your money in stock market in different companies. Okay, and they have high quality staff, they have CFA qualified people, and plus they have millions of billions of dollars of public. So they are a big fish. So they can do big game. So now they will invest in stock market, and whatever they will earn, their earnings will be reflected in these units. Their earnings will be reflected in these units on daily basis. You can check the performance of these units on a daily basis. Daily, night time, you can check the NAV, net asset value, right? So if a stock market will go up, your units will also go up, and if a stock market will go down, your units will also go down. Okay, got it? Now what happens, these mutual funds sometimes buy the shares, 60%, 70% shares of a company. They get the control. They get the control of some stock market companies. But you know, their intentions were not normal takeover. Listen, what are the intentions behind a normal takeover? Just go through the basics of consolidation takeover. You know, whenever one company takes over another company, the objective is external growth. We want to expand, we want to grow. That's why we acquire, and we acquire for long term. But you know, mutual funds, when mutual funds buy the shares, their intention is to resell, buy shares, and if the value goes up, simply resell it. So now when mutual funds buy shares, sometimes they get control of certain companies. So now their objective is not the control, their objective is to make the money through investment. So that's why International Accounting Standard Board says it's better to give them exclusion from consolidation. There is no need to do line by line consolidation, like adding hairs with hairs, eyes with eyes. Full time adding together is not beneficial, because investors just want to see the fair value. Investors just want to see the fair value of those shares. So that's why for these mutual funds, they have given exemptions from consolidation. If they acquire certain subsidiaries, they will be exempted from consolidation. And now International Accounting Standard Board has given a special name to these mutual funds, and that name is investment entity, IE. Investment investment entity. They are called investment entity. Okay, so these investment entities are exempt from consolidation. If they get control of certain subsidiaries, they don't need to do consolidation. They just have to report it, these investment as fair value through PNL. Okay, now simply go slow, simply read these slides, and I'll walk through these slides with you guys. See, an exception to the no exclusion from consolidation principle is made where the parent is an investment entity. I just explain you what investment entity is by giving the example of mutual fund. Investment in subsidiaries are not consolidated and instead are held at fair value through profit and loss. Now this allows an investment entity to account for all its investments, whatever interest is held at fair value through profit and loss. The IASB believes this approach provides more relevant information to users. See, again, they are promoting relevance, because now there is no need to do line full-time adding together. It won't benefit us. We won't be able to see the full-time performance of that company, because we are interested in fair value. Okay, now the accounting treatment is mandatory for entities meeting the definition of investment entity. Okay, now these are the characteristics. See, first of all, what investment entity does: obtain funds from one or more investors for the purpose of providing those investors with the investment management services. Okay, investment entity is just managing your funds for the purpose of investment. Okay, commits to its investor that its business purpose is to invest funds solely for returns from capital appreciation. See, these are stock market and investment income, or both. Be very clear. Listen, mutual funds can't do the soap business, they can't do the car business, they can't do the shampoo business. No, if you want to do car business, go. If you want to invest in car business, go and directly invest in Tesla. Just think about it. Their objective is to invest in shares. And give you guys return through capital appreciation or investment income. Okay, and now the C part measures and evaluates the performance of substantially all of its investment on a fair value basis. Yes, they record it at fair value. That's why they are eligible for exemption. That's why standard has said to record it at fair value through PNL. Okay, now some extra typical characteristic. Listen, they have more than one investment. Yes, obviously, otherwise it will look dummy. So mutual funds normally invest in number of companies. So more than one investment, more than one investor, investors that are not related parties to the entity. Yes, investors should be independent. Investors should be independent. Okay. Ownership interest in the form of equity or similar interest. Yes, these units reflects a certain ownership, right? They bear risk. These investors bear the risk. These investors bear the risk. Okay. So let me wait. Yes. So this is the picture. This is the complete. Wait. This is the complete thing. Please tell me the chat on the chat box. Did you guys understand it? Did you guys understand it? Please. I repeat one more time. Listen very carefully. Listen. What is the objective of normal takeover? The objective of normal takeover is growth, is expansion. Just think. And when the objective is expansion, you should do adding together so that you look very healthy. So that you look very healthy, that yes, now my arms are very strong. I have 3 companies. That's why in the normal circumstances we do adding together, right? But here the objective is just resale. You are buying shares, and once the value goes up, you sell it. And you have to report to your investors the fair value. That's why standard has given the exemption. That's why standard has given the exemption. There is one question, but be very careful. Investment, sir, the investment entities are also called institutional investors. Yes, they are one of the institutional investors. Yes, they may be institutional investors. Are institutional investors are other people as well, like pension funds. Those who maintain pension funds, they are also called institutional investors. Okay. So don't forget these three conditions A, B, C. These three conditions A, B, C are very important for investment entities. And as per my prediction, they haven't tested this area before. So it may come, because examiner, SBR examiners test different things. And if you see latest past papers, they normally touch IFRS 10. 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 Okay. Now, yes, shareholders can be related parties. Yes, shareholders can be related parties. Now, dear students, today we are going to start question number 2. Today we are going to start question number 2 of December 2021, the latest past paper. Okay. Now, as per my observation, this question is scoring question. This is a 20-mark question. I think those who have studied properly, they can score 15 marks. They can score 15 to 14 marks. And out of 20, 14 to 15 marks, not bad at all. Okay. Now let's start and let's highlight the points. The agency group manufactures products for the medical industry. They have been suffering increased competition. They have been increased competition, and therefore have sold a license to distribute an existing product, and have also developed a new product they hope will improve their market reputation. Okay. So just by reading 3 lines, what is coming in my mind? Listen. First of all, this question number 2, normally ethics comes in question number 2. Listen. And there is one more body, ICAW. In ICAW corporate reporting paper, ethics is a routine part. Ethical issues are routine thing. Listen. So when companies are suffering with extreme competition, this is highly likely that now they can do unethical things. Now they can manipulate. They can manipulate profits. They can manipulate profits. Similarly, one more thing, because now we are on this part. That's why I'm saying, in ICW, this comes routines that we are going to. Our company was a private limited company. Previously, our company was private limited company, and now we are going to be public limited. Now we are going to be public limited. So when you want to be public limited, so definitely you want more money from the market. Everybody want more money from the market. So if you want more money from the market, you need to show high EPS and high profits. So normally in that year or the previous year, when you want to go public, at that time there is high chances of manipulation. There is high chances of manipulation, right? Okay. Similarly, when you want to sell similarly, when you want to sell the running business, when you want to sell the running business of your company, then also you do some unethical practices. It's simple that whenever you want to sell your car, you clean it and you make it tip top. Okay, you do makeup so that you get the high price. Okay, so this is the point. We'll continue with now. Second, they have sold the license, so there will be some derecognition issues. There will be some derecognition issues, that whether the sale is genuine or not in this question. Okay, and then they have developed a new product. I hope you remember IAS 38 intangible assets. IAS 38 intangible assets. And intangible assets, you hope you remember the criteria of pirate, PIRATE, internally generated development cost. Internally generated intangible assets, you need to fulfill that criteria, and this criteria will be tested. This criteria will be tested in this question, because they are going to develop a product. They are going to develop a product. Okay, now let's start with first para. And what technique will I will follow today with this paragraph? First I'll read this paragraph. This will be fresh in your mind. Okay, and then I'll immediately take to the requirement of this question, this paragraph, so that it will be easier for you to understand. And today we are not going to do baby typing. Okay, right? On 1st October X7, the finance director, Miss Malgan, a financial accountant, recruited Mr. Ravi as an ACCA student. Now, the first issue, they hired ACCA student. They didn't hire qualified member. They hired ACCA student. So there is a issue. There is an issue of competence. There is an issue of competence. Like, let me relate. In ICW, this question comes very routine, that in audit, that we are auditor, and we have sent a young guy who is still a student, and we have sent him on technical audit of deferred tax, IS 12 and financial instrument. So IS 12 is a very technical standard. Even you guys don't know. Even you guys don't know after studies. So IS 12 financial instrument, they are technical standards, and if they are dealt by kids or those who are just students, so definitely they can't they don't have that much in-depth knowledge. So the final output will be not good. Okay, so this is one of the issue. You can think over it. Think these issues. Now, accountant on a temporary employment contract. Now wait, I would recommend you guys to must even I'll send you, don't worry, to must read the exam report of this paper. Examiner has discussed this part. Oh, very good, very good. Examiner has raised 6 to 7 points, from this paragraph. Okay, so temporary employment contract. Now, temporary employment which can be terminated. First of all, such contract itself are unethical. Why? Because employer can terminate any time without giving any redundancy pay or anything. So in such cases, normally employers may act unethical. So this is the first unethical thing. Second, when this is a temporary contract, so employer may blackmail employer may blackmail the employee that we can fire you anytime if you don't do this. So these things may happen. Or come to the employee side, when in the employee side there are two aspects. When this is a temporary contract, you employee will be ready to accept whatever management says, good or bad, so anything may happen, unethical things may happen. And number two, when this is a temporary contract, so employee won't have motivation. He knows that I'm here for just 2 months. So he won't work hard. He won't give his 100%. So again, the quality issues, again, the quality of output will be sacrificed. Just wait. When we buy a car on rent, just compare it. When we buy a car on rent, we just don't care. We smoke in that car, we drink in that car, we do reckless driving with that car, because we know we have just taken that car for 15 days. This is not our own car. Same is the case here. So see, in these two lines, many issues are there, many issues I have raised. One more issue. When this guy is ACCA student, so there is one thing in the back of his mind, that I'm just a kid. So all the time he will be dependent on the seniors, he will keep asking seniors. So one thing is in his mind, that if I do some mistake, still I won't be responsible, they are responsible, because my knowledge is less. Are you getting? Please tell me, chat box. Are you getting? Please participate. Please participate. Yes. Thank you for typing. Now, Mr. Ravi has found it difficult to find employment and therefore accepted the risk attached to the employment contract. C compulsion. Mr. Ravi, that accountant was unemployed. Previously, he was unemployed. He was looking for the job. However, the jurisdiction has laws which protect employees from termination due to discrimination. But as this contract specifically says that you can terminate anytime, so there are no benefits attached to it. Okay, Mr. Ravi has been told by Miss Malgan that there has been, starting the global slowdown in business, and that the biggest uncertainty is customer demand. She has therefore impressed upon Mr. Ravi that the company profitability targets are based upon achieving 30% higher net profit than their nearest competitors. Be very careful. To be very honest, I teach this thing to kids, FA level, F3, ACCA part 1 level, found fundamental level student. I teach this thing. Wait, this last line which I just read, this is against neutrality. Because you have a pre-planned game. Wait, we all make income statement. We start income statement with sales, cost of sale, gross profit, like this. When accountants are given such targets, they start income statement from net profit. They first write the net profit, $3 billion, and then they go upward. So this is totally unfair. There is a pre-planned game. Okay, right? So this is one more ethical issue. Now, next para, this para. Miss Malgan has been under significant pressure from the board of directors to meet performance targets and would normally prepare the year-end financial statements. However, for the current year end, she has delegated this task to Mr. Ravi. Now listen, one more point. This is written in examiner report as well. The board pressurizing Miss Malgan, and then Miss Malgan pressurizing this guy. One thing. Second issue. Listen. That means the year-end financial statement of a big company is not a joke. So it should be made by seniors. It should be made by seniors, but they have given task to junior. So again, there will be quality issues. There will be quality issues, quality compromises, right? Now, now the accounting. You know, when I teach in my normal class, I always say that in SBR ethics, ethics, first there will be an accounting issue and then there will be an ethical issue. That means ethical issues will normally be connected with accounting issues. See, so they have given the accounting. Mr. Ravi has included in profit and loss the foreign exchange gains arising on the retranslation of a foreign subsidiary which is held for sale. Now stop. I hope you remember, I hope all of you have studied consolidation, and in consolidation there is an area of foreign subsidiary. We call it foreign operation as well. And you know, foreign exchange gains and losses, foreign exchange gain and losses of foreign operations like goodwill, exchange gain or loss of goodwill, or exchange gain or loss of net assets of foreign operation, they are recorded in OCI now. These foreign exchange gains or losses are recorded in OCI now. And when in future, open your ears, when in future you sell your, when in future you will sell your subsidiary, then you transfer that OCI to PNL, that OCI to PNL, that OCI to PNL. Okay, but not before sale. It's strictly not before sale. You cannot transfer that OCI or OCE into PNL, not at all, even not at the stage of held for sale. There is a difference between held for sale and actual sale. So what are the wordings of standard? That yes, you can transfer the previous OCI to PNL when you sell it, when you actually sold it. So this is total wrong IFRS. Okay. And you know what is the objective? Come on, let me tell you. When you book these foreign exchange gain or losses, gains in PNL, so obviously you will have a benefit in your income statement. So your profits will go up, and when your profits will go up, your EPS will also go up. When your profits will go up, your EPS will also go up. So that's what that was they really want. Now, Mr. Ravi has included in profit or loss the foreign exchange gains arising on the retranslation of a foreign subsidiary which is held for sale. Mr. Ravi has emailed Miss Malgan informing her of the accounting treatment. Now, although Miss Malgan is an expert of IFRS, she's like you guys. She's expert like you guys. Expert in IFRS standard, she did not comment on this incorrect treatment. She just closed the eyes. She just closed the eyes of the foreign exchange gains. That means she's also involved. She knew it. She knew it, but she didn't comment. That means she really wanted artificial profits. Okay. Now, after the financial statements had been published, Miss Malgan disciplined Mr. Ravi for the incorrect accounting treatment for the foreign exchange gains. However, despite this, such a big mistake, such a basic mistakes, even of all failures know this, she's prepared to make his employment contract permanent. Simple. You scratch my back and I'll scratch yours. One hand washes the other hand. Are you getting? So it's all planned. Okay. Now, from this paragraph there are two requirements. From this paragraph there are two requirements. One requirement is related to accounting and one requirement is related to ethics. One requirement is related to accounting and one requirement is related to ethics. I always say in SBR as well in ICW corporate reporting, both papers, I say this, that ethics area is cash area, and especially this question number 2 is a scoring question. Okay, so let's first do the ethics part, and you can easily understand now because I have explained you. Okay, and be confident, please. Sorry, let me read the requirement. I didn't read the requirement. Really sorry. I have to read the requirement. See, requirement A1, just leave this requirement, leave this and read this is our requirement. See this. Discuss any ethical issues raised by Ms. Malgan's actions regarding her management of Mr. Ravi. Now, please invest good time in reading requirement. All of you, please listen. If you write irrelevant things, you won't get marks. Can you see? Can anybody see? Use microscope, please. Can anybody see safeguards? Did they ask you to write the safeguards? No. So no need to write the safeguards. You just have to raise ethical issues. That's it. That's it. You just have to raise ethical issues. You don't need to write safeguards. Yes, in some questions when we teach, we also teach the safeguards as well. But right now they are not asking. So what is the need? What is the need? Why you have to write? Already you have short time. So only you have to raise ethical issues, and you can easily pick six things from it. Okay, right? Let me show you. Okay, this is the, see, I have made the same approach. I have followed the same approach as I was following yesterday, and I will keep following next days as well. Heading, sentence, heading, sentence, heading, sentence. In this way it will be easier for examiner to give marks. That's it. 6 marks. See, 6 headings. First of all, they hire student accountant. So it's, see, I have written with the pen. This guy is less experienced, so dependent on management support. On management support. And in the back end of this guy, there is one thing that I'm not responsible, because I know nothing. I know less things, right? So this thing will encourage him to do unethical things. He can do. Okay, as Ravi is a student and he's required to adhere by certain ethical code of conduct. Yes, listen to me. Even you guys and me as well, those who are associated with ACCA, either you are students or affiliates or members, you have to act ethically. And there are a lot of things right now. I don't have time. Even during exams, you are not allowed to cheat. You are not allowed to help somebody unethically. These all, and you better know that ACCA takes actions as well for this. Okay, during COVID time, when remote examinations were at peak, there are some students, they did paper out and some such activities. So ACCA took action, and that's very genuine. So see, as Ravi is a student accountant, he's required to adhere by certain ethical code of conduct. Mr. Ravi is employed on such basis that he or the agency can choose to terminate his employment for no reason, right? So this is the first issue that he has to follow. And he's less experienced, so when you hired a less experienced guy, so there is a possibility he's always dependent on the management, and he will think that whatever I do, I'm not responsible. Then I told you that termination of contract without reason itself is an unethical contract without reason. Now no more rights. So that means employer can play using this contract. Even though the jurisdiction has laws which protect such employees from termination due to discrimination, it can be argued that the ability to terminate the employment benefits the employer more than the employee. So employer can play a lot using this termination thing. Then self-interest, very simple. Obviously, when Mr. Ravi knows, the student accountant knows that I already don't have job and I'll be fired anytime. So if I don't follow the instruction of management, right, good or bad, I'll be fired. So there is a self-interest attached. See, this could lead to impairment of self-interest, because this type of employment contract can result in unfair termination, and therefore in this fair, Mr. Ravi may follow instruction without any questioning, and further might not apply any professional skepticism in the fear of not losing his job. Okay. Now, one more point we can raise from here. Listen, when Mr. Ravi knows, see, both sides you can say, both sides you can explain. When Mr. Ravi knows that my contract is short term, my contract is short term, so he will have less motivation for all the tasks. So the quality of work may be compromised, right? So we can add this point as well. See, it can be argued that fear of termination acts as a motivation for Ravi to act unethically, and that this type of employment has provided Mr. Ravi with an opportunity as he had struggled to be employed. So you can add both points. You can add both points, both aspect. You can add both aspect. Now, overlooked errors. See, the senior management is also involved. Mr. Ravi is only an ACCA student accountant and therefore would not bear the ultimate responsibility for the inaccurate accounting for foreign exchange gains. Miss Malgan obviously knew that the accounting was, see, that the accounting was inaccurate, but because it benefited the company and help the performance target, she was prepared to overlook it. Okay, so again, some sort of self-interest by Miss Malgan as well. Okay, now Miss Malgan should not have one more very bad thing he did. She did, sorry. She did, she did, she did give all the responsibility of the final accounts, the financial statement preparation to Mr. Ravi. Okay. Miss Malgan should not have left the preparation of the year-end financial statement to Mr. Ravi, as he is a student accountant and has only been with the company for 3 months. So just think, you know, those those of those of you who are working professionally, they know that those employees who are working for 2 3 years, they know the last year things as well. There is one IS, hope you remember, IS 8, prior period errors, and that's these things, changes in accounting policies, prior period errors. So there are things which are connected to last year as well. So those employees those who have same company experience, those who are working for last 2 3 years, they are they are better for this job. Okay, and this guy has only 3 months experience. Difficult performance goals and time pressure make unethical behavior more likely. Yes, when employees are under pressure, this not only affects the well-being and motivation, but also their behavior. Okay, so it was 6 marks. If you write these 6 points, more than enough, more than enough, more than enough. Okay, finally, you can write the conclusion. See, read it. When unethical behavior leads to a gain for a company and manager chooses less severe disciplinary measures for their employees. Yes, did you see such a big error Mr. Ravi did? Total accounting treatment, basic accounting treatment he did wrong, but still the manager didn't take action. In fact, the manager promoted him. Thus, although Ms. Malgan knew the error in the financial statement, she only reprimanded Mr. Ravi after the financial statement had been published. Even then, she then offered him a full-time contract instead of his current temporary contract. So that means they work together. Now listen, examiner only asked ethical issues. They didn't ask safeguards. So those who are planning to write safeguard, they won't get any marks. Even they may be they may lose their impression. Now please hit the comment box if you understood. If you got it, please. It's better you include the conclusion. If there's a question, sir, it is mandatory to include the conclusion, it's better. But if you are running short of time, no need. No need. You can skip it as well. Yes. Could we make headings? One question by could we make headings by threads? Yes, one heading you can write with threads as well. Even I will send you on the WhatsApp group, or you can directly take it from accglobal.com. All of you listen. In the examiner report, they have raised 7 points. They have raised 7 points, although it's 6 marks question, and they have written that 6 are enough, but they discuss things in detail. So they raise 7 points. So if you read them, they rate 7 points. So you can also raise your some more points as well. One question: do we need to mention ethical principle being compromised? Yes, you can write. Sir, can you tell us the time allocated to each every question? You can simply divide it. Normally it's 1.8 minute per mark. Normally it is 1.8 minute per mark. Okay. So you better multiply it by 6 marks, so you'll get the minutes, and you can do it. You can do it. Okay. Okay. And now please keep one thing in mind, that do things with open heart. Don't try for one error or one line, or this is not a professional behavior. You guys are giving a strategic level paper. Even there are students, they attempt 70 marks and they clear. They attempt 70 marks and they clear. They don't care. They don't care about the 30 marks. If you do quality discussion with 70 marks, still you can clear. So do it with the big heart, right? Show some professional behavior. Even examiner wants to give you professional marks, so be professional now. Now I'm moving towards, don't worry, I'll share the slides with you. Now I'm moving towards the first question, first part 1A, which is the pure free marks. I would say free marks. Now discuss the appropriateness of Ravi accounting treatment of the foreign exchange gains on the retranslation of the foreign subsidiary which is held for sale. Obviously it's wrong. You just have to tell the treatment. That's why it's just 3 to 4 marks part. That's why it's just a 3 to 4 marks part. Okay, so you need to start discussing like that, that with foreign operations, the exchange gains or losses on net assets. And wait, one more thing in my mind. After this part, I'll do a quiz. You have to give the answer. I will do a quiz. Okay, so listen. Foreign exchange gains on losses of foreign operation that is related to goodwill or net assets must be booked in OCI now. But when this subsidiary is sold in future, we reclassify. The better word is reclassify those gains into PNL. We reclassify those gains into PNL. Okay, but not when it is held for sale. It should be actually sold, right? Okay, see this please. First, see IS 21. IS 21, the effects of change. One more question. Thank you. If students normally ask this thing, that sir, sometimes we forgot the number of IS, like it's IS 21 or IS 23 or 24. So if you're not sure about the number, just write this according to International Financial Reporting Standard. That's it. That's also enough. Okay. IS 21, the effects of changes in foreign exchange rates requires gains or losses to be reclassified from equity to statement of profit and loss as a reclassification adjustment, right? This is the heading. Now, when a group has a foreign subsidiary, a group exchange difference will arise on the retranslation of the subsidiary's goodwill and net assets. Yes, definitely, because when you bought that subsidiary at that time, the exchange rates were different, and now the exchange rates are different. Okay. Application number 2, on the disposal of the subsidiary, IAS 21 requires that the net cumulative balance of the group exchange differences to be reclassified from equity to the SOPL, that is statement of profit and loss, as a reclassification adjustment. Okay, like reclassification means from equity to PNL. Now Mr. Ravi should not have included the exchange gains arising on the retranslation of the foreign subsidiary in the SOPL, as it is currently only held for sale. Okay, only held for sale, not sold. So this is wrong. Now finally, when the subsidiary is then sold, the gains accumulated in OCE may be reclassified to profit and loss. Yes, you can do it in future. You can do it in future, but not now. You can do it in future, but not now. You can do it in future, but not now. Did you understand? Did you understand? Please write on the chat box. How to gain professional marks? Listen, you can see the heading sentence, the flow of sentence, the structure of the answer, the conclusion, the introduction, appropriate wordings, professional language. These all things gives you professional marks. Proper references, proper references. Now I'm going to do a quiz. Please write it properly, and this is very important thing. I think when I teach, I repeat this thing 5 to 6 times just to fix this thing in the mind of students. Okay, now look at me. Look at me. This is one of the example, this foreign exchange gains or losses, that these exchange gain or losses are parked in OCI now, but when the subsidiary is sold, they will be transferred to in PNL in future. In PNL in future means today OCI, and in future this OCI will be transferred to PNL. So this is the first example of such things. Are there any other things in your SBR course in which you park things in OCI now and then transfer it into PNL in future? Please write. Are there any other things in your course which you park things in OCI now and in future you transfer in future? Very good. Some students are active, some are doing wrong. Yes, student, there are two more things. There are two more things. If you want to write, you can write. I don't have pen now. I don't have pen. You can write. Listen. The first is, you remember IFRS 9, fair value through OCI, debt investment, fair value through OCI, financial assets, fair value through OCI, debt investment. If you buy debt investment and if you classify it in fair value through OCI, so any fair value gains or losses you will book today in OCI, and when you sell it in future, you will transfer that OCI into PNL. This is the first example. This is the first example, don't forget. And you know the second example? The second example is cash flow hedge accounting. Cash flow hedge accounting, right? Listen, in cash flow hedge accounting, when you have hedging instrument, when you have hedging instrument, when there is a gain or loss, when there is a effective gain or loss, when there is a effective gain or loss on hedging instrument, you park it in OCI now. You park it in OCI now, and then you transfer it into PNL in future, right? So basically there are total three things. One thing is we just did, and the two things I gave you example. Better write it. See, these are very quick things. Even sometimes they are asked in interview. And one more thing, be very open. We are not doing a normal classes right now. This is revision days. So I expect that you all have studied previously. Okay, so please be professional. One thing is wrong. Wait, this thing does not fit with IS 16. No, this example does not fit with IS 16. You know, in IS 16, when you do revaluation, you book revaluation reserve, but that revaluation reserve never transfer in PNL in future. That revaluation reserve transfers in retained earning. So there is a difference between PNL and retained earning. Okay, so IS 16 example does not fit here. Be careful, please. I hope you understood my point. Don't worry, if somebody is asking about cash flow hedge, I will repeat cash flow hedge in the next meeting. Don't worry, okay, don't worry, please. Now this is the next requirement. This comprises of little IS 38 and then IFRS 15 and then common sense. Okay, now listen. But before I read this requirement, let me give you a quick recap. Of IFRS 15 stage 2. IFRS 15, the stage 1 is the contract should be perfect. Remember, the contract should be perfect. Stage 2, you need to identify the performance obligation. In stage 2, you need to identify the different performance obligation. So what happens, please look at here. Sometimes the whole contract is a single performance obligation, and sometimes there are different separate performance obligation in one contract. You know this. Sometimes the whole contract is a single performance obligation, and sometimes the contract contains different separate performance obligation. Now, in order to meet the criteria of separate performance obligation, these are the shortcuts. See, read these two words. Those performance obligations should be provided separately, means separately provided in the contract, and benefited separately to the customer. That means if you are providing two things, if you are providing two performance obligation, customer can benefit from each one of them separately, can enjoy separately each of them. Okay, so provided separately, benefited separately. This is the identification of separate performance obligation. Now let me give you a few examples. See, books plus teaching services. Listen, even in my institute back in 2009, when students used to come for admission in the basic level, so we used to charge a single amount, and in that single amount we used to provide two things: books, a set of books, BPP, Kaplan study text, and our own book sets, and then 1 year teaching service. Now basically these two are separate performance obligation, because we are providing both of things separately in the contract. And yes, customer is getting benefit from these two things separately. Why? From books, there are many students, they clear papers through books, so books can give separate benefit to the students. Yes, and teaching services give separate benefit. So books and teaching services are two different things. Okay, similarly, sim plus phone, you have seen this, what we call it contract phone. Now all over the world this phenomena is very common. Okay, you go to the T-Mobile or any company, and you buy, if you buy a contract sim for 2 years, so they give you a discounted phone. Okay, so that means they are giving you two things. Phone gives you a separate benefit, and the sim service gives you a separate benefit. Okay, so these two are separate performance obligation. The third example, generator plus maintenance service. Wait, this example came in your FR level, the previous paper, F7 or FR level exam final account. I've seen many times. Listen, my company sells generator, and When customer comes, we charge some extra amount and we say, okay, we are giving you 3 years maintenance service with this generator sale. Okay, so now we are providing basically two things. The first thing is generator, and the second thing is 3 years maintenance service. Obviously, in market, these two things are provided separately by different separate peoples. So they are provided separately in the contract. And yes, customers also get separate benefit from these two things. So these two are separate performance obligation, separate performance obligation. My dear students, kindly please comment. I have already given you 3 examples, and I think for revision days 3 examples are too much. All of you please write. Okay, now let's move to the question. Sale of license, sale of license. Listen, on 1st January X7, agency company granted, sold Kokila company a license with no end date to sell. That means forever. We have sold it forever. Okay. A headache product, to sell a headache product hidden in South America, right? That means we have given them rights to sell this product in South America forever. Forever. The whole South American market is yours. Go enjoy. Agency company has retained the rights to sell hidden in the rest of the world. Okay, so what is the contract? I have told you guys, take my license, take this license to sell in South America only forever, but the rest of the world I'll cover. Rest of the world is mine. Okay, now the South American market's relative value compared to the rest of the world is 20%. Important point. So that means out of my, if listen, we have to make a base. We have to go for a reasonable base, that how much percentage license has been sold. So see, through market share it's 20%. So for example, look at here. For example, look, the cost of license in my books is 100 million. Just an example. Let us say the cost of license in my books is 100 million. In my books is 100 million, and I have sold 20% of it. So I will be de-recognizing 100 million times 20%. 20 million I'll de-recognize, because 20 million is sold. 20 million portion is sold forever. Now the very important point, see, I have just invested time with you guys for this. See this, the manufacturing process used to produce hidden is not specialized, and several other entities could also manufacture it. For Kokila company will purchase hidden directly from agency company at a cost plus 50%. The product has been sold for many years. Now wait, that means, listen, for example, I am an agency company and you people are Kokila, right? So I have given you the license, and now there is a product as well. There is a medicine product. Just think it's a medical product. So now you have option. You can buy that product from me for resale, and you can buy from other manufacturer as well. You have the license. I have given you the license. You can produce from anywhere. So that means this thing says these are two different performance obligation. License is a separate performance obligation. Giving license is a separate performance obligation. It is giving you a separate benefit. And the manufacturing facility, this is a separate performance obligation. You can do it from anywhere. See, this is very important point. These two are separate things. Giving license is a separate thing, and giving this service is a separate thing, because Kokila company can manufacture this product from anywhere, and we don't prohibit them to do so. Okay, so these are two performance obligations, separate things. And right now we have just sold the license. Okay, Now, on 1st January X7, Kokila company made upfront payment of 15 million. 15 million, that means they paid us, so we are getting the cash. We as an agency company getting the cash, and will make an additional of 3 million when South American sales exceeds $35 million. When South American sales exceeds $35 million, this is related to future. Now wait, this 15 million we received now, this is for the license, and this additional thing is a variable consideration. This is a variable consideration. I'm sure you guys know the stage 3 of IFRS 15. Stage 3 of IFRS 15. Whenever there is a variable consideration is involved, you can only book the variable revenue. You can only book the variable revenue when there is a high probability, when the reversal is impossible. When the reversal is impossible, when the reversal is impossible, then you can book, one thing. So just think, no probability is given, this is a future thing, so that's why you won't book. And one super argument, now I am giving you a super argument for this variable future thing. This additional 3 million variable thing, I am giving you a super arguments. Listen, you know, in IFRS 15 stage 5, in IFRS 15 stage 5, you remember the word when to book revenue. When to book revenue, remember this words, listen the golden words. You can only book the revenue once you satisfy the performance obligation. Once the performance obligation is satisfied, these are the golden words of IFRS 15. Once the performance obligation is satisfied, then you can book. So do you think did you satisfy the performance obligation? This payment will only be received when these people will do 35 million sales, when the Kokila company will do $35 million sales. So that sale has not been happened yet, so that means performance obligation has not been satisfied yet. So no, you can't book this additional amount. You can't book these additional amount. You can only book 15 million, and for 15 million you have sold the license. Okay, and how much percentage license you sold? Look at here, how much percentage license you sold? Please check how much. Check the screen. How much percentage license you sold? 20%. How much percentage license you sold? 20%. Okay, so see, agency company had correctly capitalized development cost for hidden as an intangible asset for a carrying amount of 30 million. See, I gave you this example for 100 million. So in our books, the total license value is 30 million. In our books, the total license value is how much? 30 million. And we sold how much license? Only 20%. So tell me, 30 millions times 20%, 30 millions times 20% times 20%, 30 millions times 20% is how much? That is 6 million. So that means 6 million license will de-recognize, 6 million intangible asset we de-recognize. Can anybody tell me how much is the gain on disposal? Can anybody tell me how much is the gain on disposal, please, in the comment box? Good. The gain, I will show you the question. I'm just my question is, how much is the gain on disposal we can book for this, for the disposal, or for the disposal? One reply. You can say it a contingent consideration, but this contingent consideration is not related to IFRS 3 business combination. That is a different IS. And that is applied when you sell the running business. when you sell the running business, not just a license. Please be careful. Be careful, beta, dear. Now, let me first show you. I have already discussed this part, but I'll help for your help. I'll show you the double entry as well. Giving you 30 seconds. Just give a quick read. Give a quick read to this question. Now listen, 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 listen. First of all, read the requirement. This is the requirement. Discuss how the granting sale of the license to Kokila should be accounted for by agency on 1st January X7. Simple requirement. Simple requirement. Okay, let's start. First of all, IS 38. IS 38. Agency company had correctly capitalized development cost for hidden at a carrying amount of 30 million. Yes, this is the previous story. IS 38 intangible asset states that intangible asset, in this case, a proportion of the development cost may be derecognized on disposal when no future economic benefit are expected from its use or disposal. Now wait, this is very general thing. Asset is anything. Asset, listen, SBR is a lot about common sense. It's more about common sense. Asset is anything which gives you economic benefit. Okay, so now when we have transferred all the economic benefit of South American market, so we won't be getting any economic benefit now. So that means now we have to de-recognize. Now we need to de-recognize a certain portion, and that portion is 20%, which we are going to make the entry. Okay, now next, IFRS 15 implication. Hence, the gain or loss arising on the derecognition is the difference between net proceeds and the carrying amount of the asset. It's like gain on disposal. Gains are not classified as revenue. Now wait, revenue means, sales revenue means top of the income statement. Sales revenue means top of the income statement. You know this? And revenue is only booked when you sell your inventory, when you sell your primary product, but my dear students, when you sell your fixed assets, the gain or loss on disposal are not booked in revenue, they are booked in other income. Okay, so don't ever think that you will be booking on the top of the line of the income statement, right? The amount of gains or losses arising from the derecognition will be affected by the determination of the transaction price with reference to IFRS 15 revenue from. Yes, you need to calculate the price. Okay, and that price is 15 million, I think. Now Kokila can benefit from the, now this is the two separate performance obligation. This part is two separate performance obligation. Remember, we have given the license and now Kokila is independent. Kokila can buy products from us as well, and Kokila can buy from any other manufacturer as well. Okay, so there is no restriction. So that means license giving a separate benefit and the other services giving the separate benefit. So it's totally a separate performance obligation, and this deal is about license. This deal is about license. Kokila company can benefit from the license without agency companies manufacturing services because there are other entities which can provide the manufacturing service. Therefore, agency companies promise to grant the license and to provide manufacturing services are separately identifiable, and separate PO means separate performance obligation, and they are separate performance obligation. They are separate performance obligations. Okay, now see this. The consideration for the license comprises of the upfront payment of 15 million and a variable consideration of 3 million. Initially, initially only the upfront payment will be recognized as proceeds together with the gain on disposal. Why initial payment will be recognized? Because the future payment is variable consideration, and variable consideration is only booked when there is a high probability and no probability is written. And the best answer, even the best answer, is the performance obligation has not yet satisfied. See, the variable consideration will only be recognized in SOPL when it occurs. See, this is the part. This is the part. The performance obligation needs to be satisfied before the payment is recognized. Therefore, again, again is recognized on the disposal of the South American development cost of 9 million. See this working. Bank debit development costs by 6 million, because 30 million times 20% is 6, and the remaining will go in P&L. Did you understand, please? My dear student, look at here. Just think. I have a property. Leave the intangible asset. I have a property. Property is a non-current asset. Yes. Yes. That property has 10 floors. Okay. Today I sold 2 floors. So when I sold 2 floors, so definitely now that 2 floors does not belong to me. Does not belongs to me. So should I still recognize them or should I de-recognize them? You tell me. I have sold out of 10 floors. I have sold 2 floors. So definitely I need to de-recognize those 2 floors. Just think. So if I have to de-recognize, so definitely there's a price is also coming. So definitely there should be a gain or loss on disposal. So same is the case here. This license, through this license, we were selling this product worldwide. Through this license, we were selling this product worldwide. We were selling this product worldwide. Now, the 20% portion of the world, let us say South America in terms of market share. So 20% of the license belongs to South America, and we have sold that license to somebody else. So definitely we need to de-recognize that 30% license. Now the total value of the license is 30 million. Now the total value of the license in our books was 30 millions, and we have sold 20% out of it. So 30 millions times 20% is 6 million. So definitely we need to de-recognize the 6 million. See the entry now. See, 6 million, we de-recognize this thing, see, and we receive 15. So 15 minus 6, the remaining is the gain on disposal. 15 minus 6, the remaining is the gain on disposal. Oops. Okay. Now the last part of the question, that is drug development. Now wait. Do you know the meaning? Have you ever heard about IS 38? One more thing. I have made lot of short videos regarding SBR, and even the examiner has written many articles. So even in my orientation, I say this thing, that this is the time of intangible asset. The world where the world right now is, this is the time of intangible asset. accept it, accept it. You go and check the top 10 companies of the world, they are all dealing in intangible asset, to be very honest. So when this is the time of intangible assets, when this is the time of intangible assets, is 38 is the hot cake. Hot cake. You all must read the articles, you all must read the lectures of is 38 for sure. The examiner can ask anything related to is 38. Keep this in mind, or I would say learn it, simple, learn it. Okay, now wait. In is 38 you have option to buy a ready-made purchased intangible, you have option to buy a ready-made purchased intangible asset, purchased intangible asset, right? And you can produce your own intangible assets as well. You can produce your own intangible assets as well. Okay, purchased intangible asset is a separate thing. This is not related to this requirement. We are discussing about the internally generated intangible asset, right? In your own house you are making intangible asset. So there is a first stage which we call research stage. Research stage is basically very initial stage, initial stage. And then at that and at research stage, normally there is no confirmation, that the final product will come or not. So that's why is 38 clearly says that simply book the research cost in P&L. You are not allowed, to record it as an asset. Simple. Okay, because research is the initial stage. Okay, now the second stage, is development stage. The second stage is development stage. The second stage is development stage, right? Okay, what is development stage? It means application of that knowledge obtained. Whatever knowledge you got in research stage, now you are going to apply it. So this is the advanced stage. So now standard board says, okay, at development stage you can record the development cost as an asset if you meet a criteria, if you meet certain criteria. And that criteria is pirate, pirate criteria, right? That criteria is pirate. Probable chances of economic benefit, intention to complete, and there are 6 total things, right? And you know the objective, what is the objective of that pirate? That finally you get the economic benefit from it. Finally you get the economic benefits, because the asset is anything which gives you economic benefit. Asset is anything which gives you economic benefit. Okay, so because you are asking permission from International Accounting Standard Board that we need to capitalize, we need to record development cost as an asset. So they are saying, okay, if you are sure about future economic benefit, just book it. But if you are not sure, then stay away. You are not allowed to book asset, you have to book expense. Now I have given you a basic grassroots level summary of this. Now read it, come on, read it now. Agency company is developing a biosimilar product for the treatment of a particular medical condition, right? Okay, they are developing a biosimilar product is one which is highly similar to another which has already been given regulatory approval. That means previously, go slow, previously we launched a product and now we are going to launch a similar product like that product. This is all about medicine. Okay, so one existing product has already taken the regulatory approval, but this is a new product. Okay, similar to that. Now the existing approved product Zedix patent is expiring. See that product, the existing product patent is now about to expire. Let us say we got the permission for 4 years and now the 4 years are about to end. This is just an example. And agency company has applied to the government for the regulatory approval of its new product, we have applied for this new product. Okay, now see, important part is starting now. The submission includes an analysis which compares UDIX to agency company's proposed product in order to demonstrate biosimilarity. See, the documents which we have submitted to government, the document which we have submitted to government contains similarities. We are going to give them arguments that yes, this product is also similar to the last product. See the documents, we are showing the documents to government. See this, the government has reviewed the analysis and allowed agency company to undertake initial medical trials. Wait, government has just allowed us to do trials. This does not mean that the product is approved. Government has reviewed and just allowed us trials. So trial is initial stage, it's not final approval. So this is the first negative point. This is the first negative point. Open your eyes now. Agency company feels that the trials are going well. Okay, this is our feeling. The product is used in the treatment of a very specific condition which affects to only a small group of people. Wait, you know, you can only capitalize development cost if you earn from that development cost. You can only capitalize development cost, you can only capitalize that formula if that formula will make you dollars, if that formula will make you economic benefit. See, but this drug will be used by very small number of people, so there is no good earnings, there is no good future earnings. See, this is a negative point. Then agency company has decided to develop this product for just reputational reasons. That means nothing to earn, just we want to maintain our reputation. A person using this drug will only pay a notional, open your eyes, this is the end, notional amount for the product. That means we are not going to earn it, we are not going to earn good things from it. So that means the probable chances of economic benefit point is not fulfilled. So that means you cannot capitalize this project. There are two defects which we can easily identify. Number one, government has just given us allowed to do trials, just trials. No, it's not a regulatory approval. Number one. Number two, this product, where if this product is project, when this project will be completed, this will be used by a small group of people, so there is not a good earning. And number three, they will pay us a notional, very little coins, they will pay us coins. So it clearly says no more economic benefit, and when there is no more economic benefit, you cannot record asset. Simply book the expense, that's it. Now read the requirement. Now wait, first reply on the chat box. Did you understand? Reply on the chat box. This was the peak of spoon feeding. This was the peak of spoon feeding. Wait, sorry, I missed the requirement. Now, what is the requirement? Discuss the accounting treatment. Discuss the accounting treatment of the cost incurred to date in developing the biosimilar drugs. Biosimilar drug. Okay, this is the part. Students, this is the part. Please check. Development cost are, so first of all, criteria. Development cost are capitalized as an intangible asset if certain criteria in IS 38 are met. There is no definitive starting point for the capitalization of internal development cost, and therefore agency company must use its judgment based on the facts and circumstances for each product. See, there is always a judgment. I told you in many IFRS there are judgments, okay, right? So you need to check whether the development stage has started or not. If you are in the research stage, straight away P&L. In development stage, yes, you can book asset, but if you meet the criteria. But if you meet the criteria, right? Now, application number one, a strong indication that agency company has met all of the IS 38 criteria arises when regulatory approval is issued. Listen, normally when government issues regulatory approval, that means you have fulfilled the major criteria for the biosimilar drug, as it proves the technical feasibility of the asset. This is often the most difficult criteria to demonstrate. Normally getting the regulatory approval is the real thing. Once you get the regulatory approval, that means you have done it. You are allowed to do it. Okay, but government has just allowed us trials, the first thing. Now the second thing, asset is anything that should generate future economic benefit and demonstrate the existence of a market. Obviously you will get the economic benefit when you have a market. Let us say I am developing a product. So where I will sell this product? Definitely I will sell this product in the market. Definitely I will sell that product in the market. So there must be a market, and for this product there is very small market we have just studied. Or the usefulness of the asset if it is to be used internally. At present, this criteria has not been met, as the product is aimed at a small group of people who will pay only a notional amount if it is an effective product. If it is an effective product, right? So that means there is no big market, plus those who will pay, they will also pay a very small amount, so no more economic benefit. So now, in addition, regulatory approval has only been applied for. We have just applied for the regulatory approval. They have just allowed us only trials, and there is no concern over the limited. There is a concern over the limited market and revenue stream. Thus, the costs are unlikely to meet the capitalization criteria, and all costs to date will be written off to profit and loss. Simply, you will be booking this to profit and loss. You will be booking this to profit and loss. You will be booking this to profit and loss. Now, oh, sorry. Please write the chat box. Please write the chat box. Did you understand? The question is done. Yes, I'll give you a break. Don't worry, I'll give you a break. Don't worry, I'll give you the break. Now, today I'm going to discuss something related to current issues. Again, somebody is asking conclusion. Yes, it's better you write the conclusion. For if you want to earn professional marks, it's better you write the conclusion. Okay, so now today we are going to discuss some sort of current issues things, some sort of technical challenges of accounting, okay. But first, keep one thing, write one thing in your book, that SBR is not an easy paper. You are doing a PhD level paper. Write it somewhere, okay, so that you will have less pain. Then you will have less pain. This is the only solution. When you make your mind, yes, we are doing difficult thing, so then it will be a routine for you. Only few people do this ACCA, and only very few people reaches till this professional level. Okay, so you are very few people, so definitely you need to you need to face this difficulty, right? Okay, now the first issue. One more question. Somebody was asking me, sir, how to prepare for current issue. First of all, there are some attempts in which normally students can't even recognize that current issue has been tested or not, to be very honest, because sometimes they just do general discussion. So it's better you read all the articles on accaglobal.com. That's your first document. Second thing, you should watch the short videos. You should read the blogs written by teachers, written on the, if you want to go in depth, listen. So there are issues on big four websites, but that big four websites are very too much time consuming. So it's better you read the articles of accaglobal.com. That's the best thing. Okay. And you must be aware what is going on in the current world. The thing which is extremely super hit will be tested in your exams. Okay. Now listen this technical issue. Open your eyes please. You all have studied IS 41, the IS related to agriculture, goats, cows, right? IS related to agriculture. In IS 41, listen what is the requirement. In IAS 41, we record all these animals at fair value less cost to sell. We record all these animals and these plants at fair value less cost to sell with changes taken to P&L, with changes taken to P&L, with changes taken to P&L, with changes taken to P&L. Yes or no? With changes taken to P&L. And what is the logic? Let me give you the logic as well. Listen. For example, I have a farmhouse. And there are a lot of goats there. So at the beginning of the year, the goats were I bought some goats. They were just 1 year old and they were short sized. Okay. So now I invested money on them. I hired, I hired boys so that they look after. I have a property. I have to pay the rent for that property where these goats are kept. Listen, I have to feed them. So there will be lot of cost. It's a proper activity. So let us say, listen, at the beginning of the year, the fair value of these animals was 100,000 pounds. The fair value of these animals was 100,000 pounds. But at the end of the year, now they are grown. They are healthy. So now the fair value is 200,000 pounds. So IS 41 says simply book this 100,000 pounds difference in the PNL as an income. Simply book this 100,000 pounds in the PNL as an income. Why? Because you need to match income and expenses. You need to match income and expenses, because you are also incurring expenses. You are giving feed, you are giving rent, you are giving salaries to the people who are looking after your animals. So on the top of the income statement, you will book the income. The fair value change will be booked in as an income, and on the downside you will book operating expenses. So there will be a proper matching of income and expenses, and you will get the true profit. This is the logic. Okay. Now listen, what happens? Did you understand this first point? Quick response. Did you understand this first point? Please, quick response. Now listen. Now the issue is, we have few animals with us, and today a newborn baby, newborn baby of cow or newborn baby of goat came, right? So what is the treatment of this newborn baby? When this newborn baby comes, we, you know what we entry make? We make that animal debit and PNL credit. This is a gain. This is a gain because we have got a new animal. We had only 3 animals. Let us say we had only 3 animals. Now with with the birth of a new animal, now we have 4 animals. So this is again. So IAS 41 says to book this event as an income. Book this event as an income. PNL credit and that asset debit. PNL credit and that asset debit, because you got the gain and there's a proper operating activity. You got it now. See, lambs born in farm have a zero cost, although right now the cost is zero to farmer, and are required to be measured at fair value Well, why can't the Premier League now go to the UK? Think about the football. Why can't the Premier League football clubs do the same to the footballers that came through their academy? You know, these Premier Leagues get players from two sources. These Premier Leagues get players from two sources. The first source, they directly buy external players from the external world and they pay them. They pay them for the rights. And yes, according to IS 38, these rights are capitalized as an intangible asset. When you buy an external player, when you buy an external player from outside, you have to capitalize that player. You have to capitalize that player. But there are some Premier Leagues, they have their own academies. They have their own academies at the back where thousands of footballers they generate, and out of those 1,000 footballers they select one or two. They select one or two in their Premier League. You know what IS 38 says? You can't recognize those players. You can't recognize those players. So see, there is a comparison. In the farmhouse, when there is a newborn baby is coming, in the farmhouse, when the newborn baby is coming of a goat, you always recognize it at fair value and you book income. But in the Premier League, when there is a when you are getting a footballer, from your own back office, from your own academy, you can't recognize it. What is the logic? The first answer is C. On farm animals, which IS is applied? C, IS 41. And on football player rights, which IS is applies? IS 38. This is the beginning. This issue is not solved. Let me solve it. Now the answer. See this. See the answer. Read the first answer. Read the first answer. You are right that IS 41 agriculture is explicit in requiring animals such as lambs that are born on the farm to be recognized as assets and measured at fair value. The issue is proper. The gain is then recognized in the profit and loss. After all, breeding is an operating activity. I told you the matching of income and expenses. I told you the matching of income and expenses. I gave you the example of goats. This treatment ensures a faithful representation of farmers statement of financial position. If the lambs were included at their zero cost, they would be invisible and therefore the accounts would be incomplete. Just think, at the beginning of the year we had 3 goats. Now we have 4 goats after a birth of a new baby. So we have to report the 4. We have to report 4 of them. Otherwise, this is this will be invisible baby. Okay. So a fair value of farm animals can easily be determined by observing their market value. Yes, you can easily calculate the fair value of animals using IFRS 13. This is because such animals are fungible in their nature. That is, 1 month old merino sheep weighing a certain weight will be worth at the same as next one and are regularly bought and sold. Yes, you know, many people buy goats. So in my country we sometimes buy goats through their weights, through their by weighing it. So there is a standard market. So see, in IS 41 we recognize these animals at fair value. We recognize these animals at fair value because we need to match. The major objective of that thing is matching principle. Okay, right? And one more thing, if you have studied IS 38, in IS 38 the initial recognition is also recorded at fair value less cost to sell. Initially animals are recorded at fair value less cost to sell. Okay. Now next thing is football. For football players, technical issue I'm going to discuss. Many times it came in exam, but let's start with a quiz. How to book intangible asset at initial recognition? Tell me, at cost or fair value? Come on, all of you. This I want to teach this lesson. What IS 38 says, please all of you tell me. At initial recognition we have to book IS 38 asset at cost or fair value? Wait, I repeat, At cost or fair value? IS 38, IS 38, cost or fair value? Initial recognition. Initial recognition is cost. Please write it somewhere. Initial recognition is cost. In IS 38, initially you need to recognize asset at cost. And now all of you open your ears and eyes, please. You know what cost means? All of you look at here. Cost means consideration provided by us to get that thing. Cost means consideration provided by us to buy that thing. For example, look at here, look at here. You are selling this phone. See, you have this phone and I want to buy this phone. In return, I am giving you this cup. All of you, please look at the screen. You guys have this phone and today I convinced you guys to sell this phone to me. That means I'm buying this phone from you and in return, I'm giving you this cup. And this cup costs $10. This cup costs $10, okay? So that means my cost for this phone, is $10. So don't forget, please, students, cost means whatever you are paying to acquire that thing. Whatever we are paying to acquire certain thing, this is called cost. Are you getting the meaning of cost? Okay. Now don't sleep. I'm giving you the proper logical answer. This is I have raised a this is a very technical issue which I have raised. These such issues may come in current issue. Now look at here, look at here, look at here. It is also true that when a Premier League football club buys a players, see, Premier League football clubs have two options. From two sources they get players. From two sources they get players. The first sources they directly get from external world, from other teams. So in that case they have to pay. In that case they have to pay, and this is a proper transaction. The amount can easily be calculated. They have to pay. They have to pay $1 million, $2 million. So there is a consideration. The cost can easily be calculated. The cost can easily be calculated because we are paying the amount. Okay. And I just told you in IS 38 you have to record your intangible asset at cost. You have to record your intangible asset at cost. Now read it. It is also true that when a Premier League football club buys a player's registration, the club recognize an intangible asset in accordance with IS 38. After all, see the logic, after all, there has been a transaction, a sum of money, see the cost, money, the transfer fee has been paid, and the buying club controls the player's registration, which should bring future economic benefits. So yes, whenever you buy external player, you record it. But by contrast, please, however, academy players, my own academy, I am a football league, I have my own academy. However, academy players that become professional footballers are not underpinned by a single transaction. You cannot calculate the cost. You cannot calculate the cost because you have 1,000 students. Just think, you are spending on 1,000 students, and out of 1,000 students, only one or two becomes hero. Only one or two becomes super hit, and you never know who will going to be super hit. So this is a blind investment. There is no reliable measure of either their cost or value because they are not bought or do not have value that can be reliably measured. I told you IS 38 says to record it at cost. IS 38 says initially intangible assets are recorded at cost. So now you are generating your own players, and you never know, and you are just giving efforts to them. You are doing their counseling. You are giving them time to exercise. You are giving. So these efforts which you are investing, you cannot value those efforts. And one more thing, out of 1,000 students, one will become hero. One will become hero. So you never know that who will become hero. See, see the example. There is after all only one Marcus Rashford, and there was only one Steven Gerrard. Those who see football, they know these names. Those who see football, they know these names. Okay. Now this is the reason. That's why if we get the players from our own academy, we don't capitalize. But if we buy players from outside world, we capitalize. Now, giving you the same logic, there are two names. One is purchase goodwill. Student, this is the right time to learn to understand this concept. Many students at this professional level, they don't know the logic. I know many students. Even I've seen the interviews as well. Purchase goodwill in business combination, consolidation, purchase goodwill we capitalize, but we never capitalize internally generated goodwill. Why? Same logic. We capitalize purchase goodwill, but we don't capitalize internally generated goodwill. Why? Reason. For purchase goodwill you give cost. For purchase goodwill you pay, and whatever cost you are giving, that can easily be measured. Yes, that can reliably measured, whatever consideration you are giving during takeover. But for internally generated goodwill, listen to me. For how internally generated goodwill is created, by giving good service, by replying to the message of students, by attending the call of a student, by attending the call of a student at midnight. Just think. So how can I value these efforts? By by smiling to students. So how can I value these efforts? Yes, internally generated goodwill is created in this way, with good marks, with positions. Just think. So you cannot calculate the cost of internally generated goodwill. That's why you cannot capitalize. That's why, because IS 38 says to record it at cost, and cost means whatever you are paying, whatever consideration you are giving. And for internally generated goodwill, the consideration what we are giving cannot be measured. Those efforts cannot be measured. This is the reason. I hope you got it. It is a technical issue, but now you guys are in final level. This is your last paper of reporting. After this paper, you won't study reporting in ACCA. But yes, if you do any other qualification like ICW, you will again study. But this is your last paper of reporting, so you must know these technical issues. Yes, and no doubt it is a technical issue. It was a technical issue. Kindly reply on the chat box now. Now let me open the chat box. Did you understand? Now please write your final comments. you know nowadays we are also teaching physical classes, and in physical classes we stand and teach, and we jump and all. In online class, you have to sit on the chair, so it's very difficult now. you know in online class, it's very difficult to sit on the chair. There is a back pain now, honestly. In physical classes, I start running, I start jumping, I do this. So, and you see students. So in online class, teaching online class, it's now something different now. Okay, yes, this guy is right. We need we need a break. Okay, 15-minute break. Enjoy. Break starts now. Okay. Welcome back. Welcome back, students. Now, as I told you, that examiner test whatever going on in this current world. Same with SBR and SBL, both papers, right? So, there is a, if you see news, if you guys are active, there is a word startups. Startups are in fashion now, especially in India, in US, everywhere. India, especially in India, right? And there are a lot of shows related to these startups as well now, right? And there are big banks also are investing. If you have heard about, there is a bank, SoftBank, the his owner Masayoshi Son. If you guys study, if you guys read the novel, read the current magazines and all, so this guy Masayoshi Son invest in a lot of startups. He invested in that WeWork, and he opened a vision fund of around 100 plus billion dollars, in which Saudi king also invested 45 billion dollars. So this was just a history. So nowadays it's very common. Startups arrange fundings from common people as well, common people as well, because now this is the time of internet technological age, so you can easily take fundings from crowd as well, right? Okay, so this crowdfunding is a very very common phenomenon nowadays. And as we are accountants, so we have to write the accounting treatments. Now wait, I'm sure you are aware of IS 8. Wait, for example, in your company, IFRS is being applied. You follow IFRS, okay? But IFRS, IFRS, the first word I means international. So IFRS cannot cover each and every transaction of the world. This is a physical limitation. So what happens if a new transaction comes in your company? If a new transaction comes in your company, what we do? Listen, these words you have to write in SBR paper a lot. Many times examiner even writes. If a new transaction comes in front of you, so first of all, you have to open the IFRS book. If luckily, if luckily you find the treatment of that transaction in IFRS book, if you find the treatment of that transaction in IFRS book, just simply apply it. For example, that transaction is covered by IS 37 or IS 38 or IFRS 9, just tuck do it. But if that transaction is not covered in any IFRS, then you should go for similar transaction with that transaction. And if there is no similar transaction, then use framework knowledge, then use conceptual framework knowledge, or we call it make your own accounting policy. Make your own accounting policy. That is the flexibility of IFRS. Okay, so now this, when you as a startup owner, when you receive funding from the crowd, so what accounting entry you have to make? So now look at here. You can make 3 entries. See, first of all, definitely that's the other party, the opposite party is giving you cash. The opposite party is giving you cash, so you will debit the cash. And now three things you may credit. The first thing is liability. The second thing is equity, and the third thing you can credit is income. Cash, debit. And on the credit side, three things you can credit. The first thing is loan, liability. The second thing is equity, and the third thing is income, right? Now depending on the case to case, that you have to acquire the treatment. Now you always need to think, you before deciding the accounting treatment, of crowdfunding, you should think about these things: what return crowd is getting, what return crowd is getting. For example, you have to give them a fixed return. You have to give them a fixed return, and you are bound, you have signed a paper that you will be giving, a fixed return every year. So it's like interest, and you have contractual obligation to deliver cash in future. You have contractual obligation to deliver cash in future. So in that case, it's a loan, right? But for example, you haven't promised anything. You said, okay, we will decide from the profits, we will give you something, from the profits we'll give you something. So if it is like ordinary dividend thing, then this is a sort of equity thing. Okay, this is all judgmental based thing which you need to discuss. Now, do they have the right means public crowd, do they have the right to get their money back? Okay, if they have right to get the money back, that means you have contractual obligation to deliver cash, then it's a liability. Then, are crowd owner of our business? Yes, sometimes in startups, in startups sometimes you sell your equity stake, sometimes you give equity stake to another party. Yes, be my partner. So in that case, obviously you have to credit equity. Now, the first thing the first thing crowdfunding could be debt. If the money received have to be repaid. If the money received, I'm sure you can read it, I am sure you can read it. If the money received have to be repaid, then there is a contractual obligation to deliver cash. Yes, if there is a contractual obligation to deliver cash, then simply apply IFRS 9. It's a debt, it's an obligation. Okay, now what IFRS 9 says, you know this. IFRS 9 should be applied, and the liability should be initially recorded at fair value less issue cost. Fair value less issue cost, that means net proceeds. That means net proceeds. Okay. Default accounting treatment is amortized cost accounting. You all better know this. Please recall your concept. For I'm not talking about financial assets. Please, students, quick recap. I'm not talking about financial asset. I am talking about financial liability. In financial liabilities, there are two heads. Remember, one is amortized cost accounting, and second is fair value through P&L. Fair value option is also there. For financial liability, there are two options. One is amortized cost, and second is fair value through P&L. Normally, the default category for financial liabilities is amortized cost. Okay, yes, fair value option in financial liabilities sometime recognized when there is a derivative nature liability. Okay, right, and there are certain more conditions. Now, the second point. Now, dear student, the second point. Crowdfunding could be equity. If the monies that have been received represent an ownership interest. If you have given the ownership interest, okay, like you have given them decision making authority, such things, then again IFRS 9 will be applied. Yes, for equity liability and equity both are dealt with IFRS 9. It is also initially recorded at fair value less issue cost. I'm sure you have studied IFRS 9, the financial instrument standard. Whenever you issue shares, listen, equity means, in simple words, if I talk related to stock market, if I compare it with the stock market, whenever you issue equity shares, so definitely in the issue of shares, if there is issue cost, you need to net off, and you need to book net amount in the equity. Okay, then crowdfunding could be revenue. Yes, if you have sometimes to generate your funds, you sell your own things, you sell some of your assets. So in that case, for future, look at me, for future, you don't have to give them any equity interest, you don't have to repay anything in future. So in that case, it's your revenue. In that case, it's your revenue. See, cash debit, remember the entry which I showed you? Remember the entry which I showed you? It was debit cash and credit three things, three out: equity, loan, or revenue. So just think, you don't have to pay back anything. So there is no loan. You are not giving equity interest to them. So in this case, you are just selling them your own, some of your own assets, and in future now you are not going to see their faces. Just bye bye. So in that case, just book the revenue. It is possible monies have been received because the company is making a sale. In this case, revenue will be booked when see again, revenue will be booked when performance obligation is satisfied. Very, very famous line. Very famous line according to IFRS 15. Very famous line according to IFRS 15. Very famous line according to IFRS 15. Okay. Yes. Very famous line according to IFRS 15. Now, these things examiner may ask in current issue, or 6 marks, 8 marks requirement they may ask. So you have a little touch up of these things. Current SBR paper, there are, it's like huge game. So there are many things you must have, little knowledge of many things so that you can elaborate. Now, what is EBITDA? What is EBITDA? Let me discuss this. This is very famous performance indicator. And there is a topic APM, alternative performance measures or additional performance measures in your course. And examiner ask things related to that also. Like 6 to 8 marks thing may come in your exam. 6 to 8 marks things you can expect 8, 9, something like that. Now, first of all, read this introduction. Go very slow and study with fresh mind. In our highly regulated world, financial statement of UK quoted companies must be drawn up and published in accordance with IFRS GAAP, right? Normally, in more than 100 countries, IFRS is applied. Thus, the format of the income statement is prescribed and standardized. And IFRS has set certain rules. We all know the rules. We all know the rules. We all know the presentation, the standard presentation. This is aimed at giving users confidence in the numbers that are reported. Yes, a regulated and standardized approach is designed to enhance comparability. Yes, they really want everybody to do almost same format, same type of accounting, so that the books are comparable. One of the objective of your framework of your standard board is to enhance comparability. We all know this. However, in addition, many companies also voluntarily produce alternative, see the word, performance measures, APMs. In other words, in addition to the various measures of performance outlined in the income statement, example operating profit and profit after tax, other measures are published. Now wait, the standard numbers, the standard names given by IFRS are not enough for this whole world, for all companies, because the nature of businesses are different, the nature of investors are different, the demand of investors are different. Investors want to see things in a different way, right? Each and everybody has a different taste, cultures are different. Now wait, so that's why the standard names, the standard presentation, the standard ratios given by IFRS are not enough to satisfy the whole accounting world, to satisfy the whole finance world. So what they do, they use their own performance indicators, extra performance indicators, right? So EBITDA is one of them. Earning before interest, tax, depreciation, amortization. Earning before interest, tax, depreciation, amortization. Okay, so this is not given by IFRS. This is the normal practice of people. This is the normal profit practice of people. Okay, now this is a tacit acknowledgement that the information required by the regulation do not wholly satisfactorily meet the information of needs of a company's user. I just told you this. I just told you this. Now, after all, it should be acknowledged that one size does not fit all. Okay, all see, IFRS standard numbers are not okay for everybody, right? APMs at their best seek to provide bespoke information about the companies. You know, bespoke software, have you ever heard? There are some ready-made software which you standardized software which you buy from the market, and sometimes you make your own software from software house. So these ratios, these APMs are your own performance indicators, right? According to the needs of your organization, you make your own performance indicators, you make your own ratios for your shareholders, for your users. Bespoke information about the company's performance that will help the user better understand the performance of the company, and even predicts its future performance, okay. Now the name of this ratio is EBITDA, earning before interest, tax, depreciation and amortization. Sometimes people call it cash profit, some people call it cash profit, some people call it cash profit. Why? Because this depreciation and amortization is a non-cash items. This depreciation and amortization is a non-cash item. So when you remove these non-cash things, the profit is almost a cash profit. You can call it a cash profit. Now, a lot of arguments for this. This is probably the most famous all APMs. This is probably the most famous of all APMs. There are other APMs as well. Okay, many companies even publish their own EBITDA, even though it is not required. There is no requirement of IFRS. Yes, this is our homemade thing and not defined by any IFRS. So let us explore why it can be argued that EBITDA is a useful measure. Now, first of all, the name of this performance indicator, students, please don't sleep, please, just few minutes with me. Earning before, the first word is interest, before interest. Why this before interest? Because, you know, for companies, open your eyes, there are two major sources of finance. One is equity and the other one is debt. One is equity and the other one is debt. Now just think, there are two companies. One company is financed totally by equity, the other company is financed totally by debt. One company is financed totally by equity and the other company is financed totally by debt. So if you compare PBT of these two companies, so the company which is financed by equity, there is no finance cost, because ordinary dividends we deduct from SOCI, from statement of change in equity, not from income statement. But those companies who are financed by loan, they will have a high interest cost. So now this comparison is not like with like. Now the comparison between these two companies are not like with like. That's why we take before interest numbers. That's why in EBITDA we take before interest numbers. I hope you got it. Now, before tax, why? See, earning before interest and tax as well. Why before tax? Simple logic. There is a possibility that these two companies belongs to two different cities, two different countries, so there may be a different tax rate. At one position the tax rate is 10%, at the other end the tax rate is 30%. So again, this comparison is not like with like, because tax rate is not in the control of management. Tax rate is not in the control of management. Please have a look, read it. Now next thing is the third was before interest, before tax, and now before depreciation and amortization. Now this is very interesting. Depreciation, first of all, depreciation is estimation. Depreciation and amortization is estimation, and you know, when you include estimation in accounting, there is a chances of fraud. We can manipulate books when we are allowed to do estimation. So it's better remove the estimation thing. It's better remove the estimation thing. Yes. So first point. Second point, and this is also non-cash. This is also non-cash. So if we remove non-cash thing, we will come to cash profit. If we remove non-cash thing, we will come to cash profits. And you know, a common man, not listen, all investors are not chartered accountants. Look at me. All investors are not chartered accountants. They don't understand accruals. Only we, me and you, we people understand accruals. A common man just understand the cash profits. So for the understandability of common man, EBITDA is a good thing, that it's a cash profit. It removes non-cash things. Now the third and the most super hit argument. See, now read between lines. Listen. You know, there are two types of businesses. One business which is grown through takeover. One business is growing through takeovers. So those business which grow through takeover, they have a purchase goodwill. They pay goodwill, and that goodwill is recognized. And that impaired, then impaired, and we book impairment and amortization as an expense. The second type of business are those business which grow organically, not through takeovers, just grow on their own. So you know, they those business who grow organically, they don't book internally generated goodwill in their books. They don't recognize internally generated goodwill in their books. Just use your brain. So just if you compare these two, in the first company there is a goodwill, in the second company there is no goodwill. The company in which you have recognized the goodwill, you are also booking the amortization or impairment. But in the second company where there is no goodwill, so there will be no amortization or impairment. So these two books are not comparable. So better take a profit which do not contain these amortization and depreciation, so that now the books will be comparable. Just use your brain. Now the books will be comparable. Use your brain. Read it. Please please read it. You know, in SBR, you should keep certain hours for reading daily. Reading, not writing, reading. Please read it, giving you time, especially giving you time. One more thing, you know, when you do takeover, you book upward fair value adjustment. See, when you do takeover, you book upward, you know, at the time of takeover, you revalue subsidiary companies, upward fair value adjustment. Because of upward fair value adjustment, in future you have to book extra depreciation. So now just think, those companies which are growing through takeovers, they will have more depreciation, and those companies which are not growing through takeover, they will have no extra depreciation. So again, these two books are not comparable. So it's better to take a profit before depreciation and amortization. Hmm. I'm sure I'm giving you time to read. I'm giving you time to read. Now, one more thing. Listen, this is very good thing. Before exceptional items, you know, it's better to exclude exceptional items. Exceptional items means one-off items. you know, one-off items and one-off events distort comparability, ruins the comparability. For example, there is a fire occurs in our organization, so it's a one-off event. For example, we unintentionally we did a crime, we broke the law, and there is a huge penalty on us because of negligence. So this penalty is a one-off event, so it's better you exclude those one-off events so that you can compare it with your past and you can compare it with your competitors as well. Okay. And in this way, see, excluding these one-off items arguably enables users to understand the underlying performance. This makes APM predictive and therefore more relevant for users. One thing I would like to tell you extra. Last month, no, in the month of December, one of my friend came from Europe. He's working in Netherlands. So he told me that these APMs are in reality, these APMs are applied in those countries. But he said we do strict accounting for these APMs. So I said, why? So he said, you know, because of these APMs, listen this, I'm telling you something extra. Because of these APMs, many analysts predict the future of company. Many analysts predicts the future profit of that company. And you know, if you hide anything from the analyst, that means analyst figures will prove wrong in the end. So they blame you, they blame the management, that management is hiding certain things from us, and that's not good for the goodwill of that company. You are not getting my point. Listen, not every part of the world these APMs are in fashion, but in Europe they apply it strictly, because on the basis of these APMs, stock market analyst predicts the future of company, predict the future profit of that company by using different figures and in details working. So when, if these future profits goes wrong, then analysts blame the company's management, that company's management is not providing proper information to us. Did you understand these points? Please write on the chat box, I would be grateful. Please, if you understand the point, please write. APM full means additional performance measurement or alternative performance measurement. Quick, write, type. Now, one more practical issue. This may be tested. Now, see the next line. See this. Earning before interest, depreciation, and COVID-19. Earning before. See, nowadays this is also coming in fashion. EBITDAC, not EBITDA, EBITDAC, earning before interest, tax, and depreciation, and COVID-19. You know, COVID-19 was also a special event, one-off event. So because of COVID-19, you can't compare your last years with this year. You can't compare your last year with this year. So definitely there are companies, they are using this APM as well. See, I've recently seen reports that some companies are considering reporting their 2020 profits before the effect of COVID-19. Not difficult, it's easy. You guys know now. The suggestion is that it would be beneficial to adapt earnings before interest, tax, depreciation, and amortization, so that it become earning before tax, depreciation, amortization, and COVID-19. Let's consider whether this EBITDA would be a useful measure for users or not. Wait. Because of the COVID-19, most business will have incurred additional cost Impairment losses, yes, impairment is was super hit in impairment in COVID. Provisions for redundancies, yes, we did. People did redundancies, people did restructuring. Restructuring was a common phenomenon of COVID. Additional cleaning cost to the name, but these could be added back to EBITDA on the basis that they were non-recurring. See, COVID-19 was a one-off event. COVID-19 was a one-off event. So these things must be added back. However, given but see this is called U-turn. This is called U-turn. You know, in in SBR paper, don't just don't just go in one direction. Always keep a room to come back. You know, in our company, in my country, or in worldwide, in major this subcontinent, politics is very dirty. Many politicians first join the first political party, then after few years they join another political party, then another political party. So you know, those politicians which are very sharp, they do criticize their last parties, but always they keep a room to go back. Always they keep a room to go back and join it again. So I always advise employees, because you guys are going to be employees. So whenever you leave leave any organization, try to leave on good pace, right? Because sometime you have to go back. So in writing the discussion, keep some room for reversal. See, however, given the likely duration of COVID-19 impact, this could be hard to argue. Impact, this could be hard. Listen, now COVID-19 is 3 years old. Just think. So do you think it's a one-off event? Do you think this is a one-off event? So this is also a question. Now the last few words. Some might advocate that EBITDA should also reflect additional hypothetical revenues and profits that would have earned. Only those who understand English, they can understand, that would have earned if the COVID-19 had not occurred. You know, there are some people, they say that if there wouldn't be any COVID-19, we will have more revenue. So let's book those imaginary revenues. Let's book that imaginary revenue. I think that's not fair. That's not fair, because they are not real revenues. That's against faithful representation. See, that's again faithful representation. Some people say that if there was no COVID-19, if there were no lockdown, we could have earned this much. Let's report those artificial imaginary earning. No, 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 don't do this. Don't do this. Yes, you can do the real bad, you can reverse the bad events, you can remove the impact of bad events, but you cannot artificially create the good events. You cannot artificially create the good events. Be careful. Be careful. Did you understand it? Now read the conclusion. Please write on the chat box, please. I will be happy if you write on the chat box. Okay, okay, good. Now there is one criticism on IFRS 3 business combination as well. There is some criticism on IFRS 3 business combination as well. Listen, let me go through it quickly, because before the break I taught you this concept. Before the break I taught you this concept, okay? And I made one video on this, a short 5-minute video on this as well, but that's video in Hindi language or Urdu language, so not all of my students can understand that language. So it's better I discuss this thing. It's a short issue, but you will have a different perspective of this. And one thing, be very clear. Current issue is a judgmental area. This is a thinking of one party. You can think the other way. You can you can disagree with me as well. This is your right. Okay, this is possible. Even I can say against my words. Okay, this is the way we take current issues. Listen, read the first para. Accounting standards are never perfect. Yes, it's not from God, it's man-made. IFRS is man-made and man can do errors. Okay, man has limitations. Humans have limitations, right? Now, goodwill, some people say goodwill is not an asset. Some people say goodwill is not an asset. Internally generated goodwill, the inherent goodwill. See, because you don't purchase anything, so there is no underpinning transaction. The first argument, no reliable measure. My favorite argument is no reliable measure. You can't measure it, because IS 38 says a good all intangible assets are initially recorded at cost. All intangible assets are initially recorded at cost, and cost means what you are paying. Cost means what consideration you are giving. So in order to generate internally generated goodwill, you do efforts, you talk politely, you give good service. Now these things cannot be measured. That's why goodwill cannot be recorded as an asset. Internally generated goodwill, this is not controversial. After all, the purpose of the statement of is one of the stewardship and being accountable to the users of the financial statement on, and is not an attempt to value the business. Listen, the objective of financial statement is not to show the valuation of business. Please be careful. Valuation is a separate thing. Valuation is done by separate analysts, and they are a separate people. The objective of financial statement is just to show the true and fair view of what is happening, right? You don't have this responsibility to show the valuation of the business. That is done by different players in the stock market. Okay, and that is done by parent company when parent company wants to buy. That is done by audit firms when they give this special service. Okay, now, so one party says goodwill is not an asset. Now the other party says goodwill is an asset, which is purchase goodwill. But goodwill is sometimes recognized as an asset. Goodwill is sometimes if it is purchase goodwill. Yes, you know this. The standard requires that the purchase goodwill on a business combination be recognized as an intangible asset. See this. Now, this line, read this line. Some still argue that the purchase goodwill is not. Some still argue that the purchase goodwill is not an asset at all, given that an asset by definition per ISB conceptual framework is a resource that is controlled. That is, but how can a business control goodwill, its own reputation? You know, wait. Have you studied CGU, cash generating unit? In cash generating unit, whenever we do impairment, we first remove the goodwill. In cash generating unit, when we allocate impairment, we simply clean the goodwill. Remember? And there are some trainers, they what logic they give, because goodwill is a weak asset as compared to other asset. Goodwill is a weak asset as compared to other asset. Listen, for example, if you want to destroy a building, you need to do a bomb blast. You need to bring the workers, they will destroy the building. But if you want to destroy the goodwill, just spread a rumor, just spread a wrong news, and it can destroy goodwill. So goodwill is a very shaky asset, right? So that's why some people say this, it's not good to record goodwill. See, this is one of the argument, one of the thinking of people. But how can a business control goodwill, its own reputation? It also a strange asset that cannot be sold separately. Now, but still the standard, okay, just surrender in front of standard. That standard says internally generated goodwill you cannot capitalize, and purchase goodwill you can capitalize. This is the standard so far. And also read this word bridge. You know, if you remember the basic consolidation, if you remember the basic consolidation, look at me. This purchase goodwill is the bridge between COI, cost of investment, COI, and fair value of net asset. This purchase goodwill basically reconciles this. So that's why it's very important. Okay. Now, next argument, please. Next argument. Because the answer to the good question is goodwill as an asset is both no and yes. In some books, goodwill is not an asset. In some books, yes, it is an asset. So now what's the problem? Those companies which are grown organically, they have internally generated goodwill and it is not recorded. And those companies, those who are generated through takeovers, through they did external growth, they have purchased goodwill. So now these two books are not comparable. These two businesses are not comparable. These two businesses are not comparable. Read it. Now I am going to pitch a super thing. Now your perception will be changed regarding this standard. Now I'm going to pitch a super thing. May you understand? This is the super thing. Listen. This is the super thing. IFRS 3 business combination is wrong to require the purchase goodwill be subject to an impairment review. Listen, IFRS 3 says this is a technical area. Now I'm coming to the technical point. Honestly, IFRS 3 says that at the date of takeover, record the purchase goodwill, and now in future do impairment testing. Now in future do impairment testing. If there is any impairment, then book impairment, otherwise no need. So now just think there is a possibility the goodwill which we bought at the time of takeover, the reputation which we bought from S company at the time of takeover, the original reputation was declined now, but because of the efforts of parent company, some new goodwill has been created. So just think, old goodwill was $100. Old goodwill we purchased from S company was $100, and that old reputation has been down to 60, but some new reputation has been added because of the efforts of parent company was 50. Parent company added 50. So 60 plus 50, now the total goodwill is 110. So the accountant, when the accountant will do future impairment review, there will be no impairment. But in reality, there is an impairment of original asset. There is an impairment of original goodwill. So that means in reality, in this case, we are booking some internally generated goodwill. This is a difficult concept. All of you read this. All of you, please read this paragraph. Read this paragraph slowly. Slow. Just think, I have a pond full of water 10 years back. After 10 years, it is still filled. But do you think the existing water 10 years before is still in that pond? No. Some water has been evaporated, and because of rain, some new water will come. So now whoever will see, they will see that the water is still same, but in reality, the old water has been vanished, has been impaired, has been gone. So this is the wrong treatment by IFRS. That means we are capitalizing our efforts. The internally generated goodwill after takeover is also being capitalized. Ooh. Did you understand or not? Let me read your chat. Yes, it's very deep. It's very deep. All of you, please comment. Just for me, please comment. I would be happy. Let me read it for you. I would argue that where year after year purchase goodwill is impairment tested and not found to have suffered a loss, that what is really happening is that the original goodwill, the original reputation is actually being dissipated and is really being gradually replaced by newly created inherent goodwill. So that means in this case you are capitalizing the internally generated goodwill, and normally internally generated goodwill are not allowed to be capitalized. And now see the example of this water. See this example. This is a super example. Super. After all, if you measure the amount of water in pond every year, you could conclude that the water level never falls. But surely after 10 years, the original water there has evaporated and been replaced by new different water. The original water in the pond is like the original goodwill at acquisition. It does dissipate over time as staff leave and new customers are attracted. So it can be argued on the basis that the original goodwill should be systematically amortized. And see, now some people says that it's better. See, now this is the new account, new arguments. Don't do impairment review. That's why people say don't do impairment review, because in the impairment review, this is the defect which we discuss. It's better you book amortization of the purchase goodwill. So it can be argued on the basis that the original goodwill, the original water should be systematically amortized. The current impairment review process ignores this dissipation and in effect allows inherent goodwill to be recognized as an asset through the back door. Now one more thing, wait, it need big heart now, please, ending 2 minutes. One more thing, what is impairment? Impairment is a sudden fall. Thought impairment is a sudden fall. But amortization, you smooth out things. Through amortization you smooth out things. And when you, if just imagine, if you adopt amortization model right now, amortization of goodwill is not allowed, please. Right now in the current IFRS world, amortization of goodwill is not allowed. But just think, if the amortization of goodwill is allowed, you can easily predict the future profit. And today I gave the example of Europe. That nowadays in modern economies, investors and analysts wants to predict future profits. Investors and analysts wants to predict the future profits. So through amortization, it is good, it is excellent to predict future profits. See, another unfortunate consequence of the impairment review process for goodwill is that it can mean in certain years reported profits fall off a cliff. This makes predicting future profit trends and harder, and so alternatively users might prefer to see purchase goodwill systematically written off. After all, if information is to be useful, it has to be relevant, and to be relevant it should be predictive. If you guys have studied the basics of framework, with relevance, this word predictive is always written. The predictive value of business should always be there. My dear students, my dear. Did you understand? Please tell me. And I would say my beautiful students, I would say these are the thinking of different people. Yes, when I make this video and I post it on YouTube and different, there are people, they comment against this video. But I said this is current issue, because outside ACCA students, especially SBR students, they know that what is current issue. Current issue means the things which are not really applied, they are in process, they are criticism, and they are thinking of different people. This is how you comment, this is how you comment. Okay, getting? So that's it for today's class. Thanks for attending the class, and I would request all of you to attend the next two classes as well, and better attend the live class. Better attend the live class, better attend the live class. Live class is very useful, plus recordings are risky. Okay, thank you, thank you, take care, take care, bye bye.